CIT applies to every company incorporated in Nigeria and every foreign company with a taxable presence here in Nigeria. The CIT rate depends on the size of the company. If a company qualifies as a small company, and that means its gross turnover is 100 million or less, or its total fixed asset is 250 million or less, that company's CIT rate is 0%. Hello, this is the first of a two-part series where we discuss companies' income tax, CIT. This first part will cover what CIT is, who should pay CIT, CIT rates, exempt entities, what constitutes revenue and taxable profits, allowable and non-allowable deductions, and capital allowances. The second part would cover things like how CIT is computed, filing requirements and deadlines, penalties, common compliance mistakes, and how tax stream supports businesses. So let's get to it. What is CIT? Now, CIT is company's income tax, and it is a direct tax imposed on the profits of incorporated entities. If a company is incorporated in Nigeria, it pays CIT on its worldwide income, that is, profits earned both within and outside Nigeria. If it is a foreign company but has a fixed base or taxable presence in Nigeria, it pays CIT on the profits attributable to that Nigerian operation. Now, the legal basis for CIT has been consolidated under the Nigeria Tax Act, which replaced the former Companies Income Tax Act. The administration of CIT, including the assessment, the filing, the penalties, and enforcement, is now governed by the Nigeria Tax Administration Act 2025, which is administered by the NRS, which has been newly established to replace the FIRS. Now, who must pay CIT? CIT applies to every company incorporated in Nigeria and every foreign company with a taxable presence here in Nigeria. This includes private limited liability companies, public companies, limited liability partnerships, companies limited by guarantee that carry on any trade or business. Now, let's talk about the CIT rate. The CIT rate depends on the size of the company. The standard CIT rate is 30% of total profit. Note, profit, not turnover or revenue. However, there's a relief for small companies. If a company qualifies as a small company, and that means its gross turnover is 100 million or less, or its total fixed asset is 250 million or less, that company's CIT rate is 0%. Now, this is a deliberate policy to support small businesses and encourage formalization. But note, even though the tax rate is 0 for small companies, they are still required to file their tax returns with the Nigeria Revenue Service, and we'll talk about this in more detail in the second part of this video. There is also a development levy of 4% of the assessable profit, which applies to all companies except small companies and non-resident companies or foreign companies. Additionally, Section 57 of the Nigeria Tax Act introduces an effective tax rate of 15% for multinational companies that have a consolidated group turnover of 750 million euros, or for Nigerian companies with an aggregate turnover of 50 billion naira. This is obviously in line with the global minimum tax requirements. Now, let's talk about exempt tax entities. Certain entities are exempt from CIT. These are religious institutions, charitable organizations, educational institutions, cooperative societies, trade unions, statutory pension funds, and sporting companies. Companies operating in the free trade zone also enjoy exemptions, as do companies that are involved in agricultural businesses for the first 5 years of their operation, as well as wholly export-oriented businesses. However, and this is critical, exemption from tax does not mean exemption from filing. Exempt entities are still required to file returns and provide information to the Nigeria Revenue Service. So the exemption covers tax liability, but not the reporting obligations. Now, let's talk about what constitutes revenue and taxable profits. Revenue, for CIT purposes includes income from the sale of goods, provision of services, rent, royalties, dividends, interest, proceeds from the sale of assets, and any other income derived from business operations. A company's assessable profit for any year of assessment are the profits of the, for that financial year immediately preceding the year that they are filing the returns. So if your company has a December year end, your 2026 assessable profits are based on your accounting numbers, your financial performance for the year ended December 2025. And this is what we call the preceding year basis of assessment. And it is important to understand it because it affects your filing timelines and when, your tax becomes payable. Now, let's talk about allowable and non-allowable deduction. Not all expenses reduce your taxable profit. The Nigeria Tax Act distinguishes clearly between what is deductible for tax purposes and what is not. Now, for instance, allowable deductions would include interest that you're paying on money borrowed for your business, which you deployed as capital for your business, rents you've paid for your business premises, salaries, wages, and employee benefits, expenses made on repairs on your premises, plants, and machinery, bad debts of doubtful debts, contributions to an approved pension scheme, cost of research and development, etc. Those are all allowable. On the other hand, some expenses expenses are not allowable, as a deduction from revenue, and these include private or domestic expenses of the owners of the business, depreciation or impairment charges. And this is important because capital allowances replace depreciation for tax purposes. So depreciation is not allowed. Any tax on profits or income, penalties and fines, contributions to unapproved pension schemes, expenses for which VAT or import duties has not been paid where required, and payments to connected parties that failed the transfer pricing arm's length test. All of these expenses are not allowable. Let's talk about capital allowances. I had mentioned earlier that depreciation is not an allowable deduction. And the reason is it is not uniform. Different companies depreciate the same asset differently. And therefore, for uniformity, the tax laws allow businesses to claim capital allowances in place of depreciation because capital allowances are uniform, right? So there are currently three main classes of assets you can claim capital allowances on. The first class, which is class 1, are assets that attract an annual allowance. That is, you can deduct 10% of the value of that asset every year. These kinds of assets include buildings, agricultural structures, masts, intangible assets, and heavy transportation equipment. These kinds of assets, you can claim 10% of their cost every year. So that means that you would have claimed 100% in 10 years, right? Now, you talk about class 2, assets that attract 20% annual capital allowance. These category cover plants and machinery, agricultural equipment, furniture and fittings, mining equipment, and other general equipment. So this one, you're depreciating, claiming capital allowance of 20% every year. So that means by year 5, you would have fully claimed the capital allowances or depreciated the asset for tax purposes. Now, talk about class 3. These are assets that attract 25% annual capital allowance. And this includes motor vehicles, software, and other miscellaneous capital expenditure. So these ones, you can fully claim the capital allowance within 4 years of acquiring the asset. Now, capital allowances are deducted from assessable profit to arrive at your total profit for tax purposes. So proper classification of your assets into the correct class is essential. And this is an area that many businesses make lots of errors. So watch out for part 2 of this video where we go straight into the second part and we discuss filing timelines, penalties, and the likes.